If you are currently on your spouse's health insurance, your coverage does not just quietly roll over the day your divorce is finalized. In fact, there is a silent 60-day clock that starts ticking the moment the judge signs your divorce decree. Miss it by a single day, and you are locked out of your family's health care plan permanently. No exceptions, no appeals. But here is the real shocker. Even if you do everything right, the bill that arrives in your mailbox a month later could be up to 400% higher than what you were paying before. If you are a smart, successful woman rebuilding her life after divorce, you cannot afford a gap in your health care. Give me 7 minutes and I'm going to show you the exact federal statutes that protect you, the silent deadline that can ruin you, and how to avoid the massive COBRA sticker shock waiting on the other side. I work with women navigating life after divorce, and I am the author of the book, $1 Million Divorce: How to Avoid Money Anxiety After Divorce Without Sacrificing Your Lifestyle. I wrote that book because I got tired of seeing successful, intelligent, recently single women hand over thousands of dollars to the state or insurance companies because they simply didn't have a reliable resource for real financial advice during this major life transition. Today, we are talking about post-divorce health insurance. A quick compliance note. I am a licensed fiduciary financial advisor, but I am not your advisor. Therefore, this video is for educational purposes only. Always consult with your legal, tax, or financial professional before making financial decisions. Do not leave this video without subscribing. Click the subscribe button right now. Every 6 days, I release a new video answering the exact post-divorce financial questions that are on your mind. Subscribe to this channel immediately so you don't miss an update. Let's start with the law. Under federal law, specifically Title 29 of the U.S. Code, Section 1163, subsection 3, this is the important part. Divorce or legal separation is officially recognized as a qualifying event for COBRA continuation coverage. This means if your ex-spouse's employer has 20 or more employees, the law states they must allow you to keep your exact same health insurance plan. And here's some good news that almost nobody realizes. While standard COBRA for job loss only lasts 18 months, COBRA for a divorced spouse lasts for up to 36 months. Under Internal Revenue Code Section 4980B, you have 3 full years of federal protection to find your own coverage. But there's a massive catch. of course. Under Treasury Regulation Section 54, spot 49 something something, you, the qualified beneficiary, have exactly 60 days to notify the plan administrator in writing that the divorce has occurred. I've seen that go sideways more than once, so let's repeat that. The qualified beneficiary has exactly 60 days to notify the plan administrator in writing that the divorce has occurred. Do not rely on your ex to do this. If the employer's human resources department doesn't receive that written notice within 60 days of your divorce decree, your right to COBRA may be legally extinguished. Therefore, you would be entirely on your own for health insurance. Now let's talk about the cost. When you were married, your ex-spouse's employer likely subsidized a massive portion of your health care premium. Once the divorce is final, that subsidy vanishes. Under the law, the employer can charge you 102% of the actual cost of the coverage. That's the employee portion, the employer's portion, plus a 2% administrative fee. If your family plan premium was about $800 a month or so out of your paycheck, the real cost of COBRA may be $2,000 or more. Just estimate numbers. We do call that COBRA sticker shock because for most people, it's pretty painful. So what do? You have three specific options. Number one, elect COBRA as a bridge. If you are undergoing medical treatment and cannot change doctors, pay the premium temporarily to protect your continuity of care. Number two, use the Affordable Care Act exchange. Divorce triggers a special enrollment period under the ACA, allowing you to shop for individual plans outside of the normal November open enrollment window. Number three, negotiate it into your settlement. If you are negotiating your divorce right now, you can add it to your settlement that your ex-spouse's business or your ex-spouse personally must pay your COBRA premiums for a set period of time. Now, this is exactly why we built the C.A.L.M scorecard. It takes less than 2 minutes and it flags the hidden transition traps like healthcare, tax basis, and cash flow to tell you if your post-divorce lifestyle is actually safe. You need to know if your lifestyle is actually safe or at risk. Please stop guessing. Click the first link in the description below and complete the C.A.L.M scorecard right now. It takes exactly 2 minutes and it will tell you immediately whether your lifestyle is protected or at risk. Do it right now before you make another financial decision. Now, once you have secured your health insurance, your next move is protecting your retirement income. There is a silent Social Security rule that could boost your monthly retirement checks by thousands of dollars, and your ex-husband will never even know you did it. He doesn't have to sign off on it, and it will not reduce his personal benefits by a single penny. But if you miss the critical 10-year deadline by even one day, you get nothing. I am showing you exactly how to claim this money in the very next video. Click here to watch it now, and I'll see you soon.